Every migrant knows two feelings: the excitement of landing the first job offer in Australia, and a few weeks later opening the payslip and going, what? Where did half of this go? If this has happened to you, you are not imagining it. Most migrants overpay tax or miss out on the money they are owed in their first year or two here. Not because they have done anything wrong, just because nobody has ever sat down and explained how tax and super actually works. I am Ash at ClearTax. I've spent the last 8 years helping migrants make sense of the exact system, and it is the same handful of mistakes over and over. This video is part 1 of 2, where I cover the fundamentals, how tax bracket works, what a salary package is, and what super means. Part 2 of this video covers the tax planning for high earners, growing your money here, and one mistake with overseas property that can cost migrants more than anything else on this list. Make sure you watch it after this video. Let's get into it. Tax brackets first. Since that's where most of the confusion starts, Australia doesn't tax your entire income at a single rate. It splits into brackets, and only the income within each bracket is taxed at the bracket's rate. Think of it as filling up a container one at a time, not as a flat rate applied to everything you earn. As of 2026, your first $18,200 is tax-free. Then 16% up to $45,000, 30% up to $135K, 37% up to $190K, and 45% only on anything above that. Add 2% Medicare Levy on top for most residents. Here is what that looks like in practice. On a $100,000 income, you would pay around $22,800 total between the tax and the Medicare, leaving take-home pay nearing $77,200. Your top bracket is 30%, but your actual effective rate, what you are really paying across the whole income, it's closer to 23%. Go up to 150K and you would pay around $39,800 in total, take home nearing around $110,000. Your effective rate lands around 27%, not 37%. That's the bit people get it wrong. Crossing into 150K doesn't mean the government suddenly takes 37% of everything you earn. It only takes 37% of what is above 135K. Everything below that stays taxed the same as before. If you are from a flat tax country, this might seem a bit strange at first. But getting a pay rise won't usually leave you worse off. You only pay the higher tax rate on the extra money you earn, not the whole income. The one thing to keep in mind is a Medicare Levy surcharge. It is an extra tax that may apply if your income exceeds certain limits and you don't have an eligible private hospital cover. If your income goes above the threshold and you don't have that cover, you may have to pay a little extra tax. You don't need to do this maths yourself. Free salary calculators can estimate your weekly, fortnightly, or annual take-home pay in seconds. They are especially useful when comparing job offers, as the same salary can result in different take-home pay, depending on whether it's quoted including or excluding super. That's something that catches many people new to Australia. For more accurate estimate of the tax deductions from your pay, you can also use ATO's tax withheld calculator to see how much tax your employer is likely to withhold each pay cycle. Which brings us to super. It's Australia's compulsory retirement savings scheme. Your employer puts a percentage of your salary into a fund for you, and it's mostly locked away until retirement. $100,000 including super means that's the total package. Your actual salary is lower once super is carved out. $100,000 plus super or excluding super means you get a full 100K and super paid on the top. That one word can be worth thousands. So before you accept anything, ask, is this including or excluding super? It's a completely normal question here. First Home Super Saver Scheme. Most migrants never heard of this one. If buying a first home here is anywhere on your radar, it's worth knowing. Instead of saving your deposit in a regular bank account, you can put voluntary contributions into your super fund. Those get taxed around 15%, well under your normal rate. When you are ready to buy, you pull those contributions back out, plus whatever they have earned, and use it for your deposit. Simple upside, money in the saving account get taxed at your full rate. Through this scheme, it's taxed at 15%. More of it ends up going towards the house. There are limits and rules, so get advice, or better yet, book a chat with our team. Can you lodge your own return? Sure, MyTax from ATO makes it manageable if your situation is simple. But first-time lodgers quietly lose money in one spot, and that is missed deductions. For example, working from home. You can likely claim a slice of your internet, electricity, even your laptop or office chair. Self-education tied to your job, union fees, professional membership, travel between work sites, all fair game. None of it looks like much on its own. Add it up over a year and it's often the difference between a small refund and a real one. We regularly see this put back several hundred to a couple $1,000 just from deductions people didn't know existed. A good accountant isn't just typing numbers into a form. They know what your job qualifies for and what the ATO wants to see if they come asking. For your first return in a new country, it's rarely money wasted. That's part 1. Tax brackets, understanding a salary package, super basics, and first home super saver scheme. If you are on a high income, combining income with a partner, or you have still got asset overseas, we have made part 2 just for you. Watch that next one. If this helped, drop a like and tell me in the comments what confused you most when you first landed. I read every comment and usually shapes the next video. This is exactly what we help migrants sort out at ClearTax. Tax, super, and decisions that come with your first year here. If you want to book a complimentary session, you will find the link in the description. See you in the next video.